But first of all, Pedro will share with us how banks and fintechs can cooperate and what his experience has been in this field. What you have to know about Pedro is that Pedro is a very innovative, agile, and multi-award winning banking leader with over 25 years of international financial services experience with leading blue chip institutions across 3 continents. He enables challenger banks to establish strategic partnerships with fintechs to create profitable financial products using an open architecture model. He's expert in driving digital banking transformations, both in terms of creating best-in-class digital customer experiences and transforming key internal support functions to fully align with the overall digital transformation programs of financial institutions. A very warm welcome to Pedro. The floor is yours.
Thank you very much, Nora. It's a pleasure to be here, and I hope everyone is ready for the afternoon sessions. I hope it doesn't get too sleepy after lunch. So let me share my content. Let me see here. Let me just give me a minute. I'm supposed to have. So I hope you can see my screen now, and let's start with the presentation.
Yes, we do see your screen.
Yeah.
Let me just put it on reading mode. I think that's better now.
Excellent.
So I'll be talking about banks and fintech cooperation. So as you know, there is this dichotomy or dilemma between obviously banks that are regulated and then the world of fintechs that is driven by technology. And usually it has a very nimble structure. It's typically a startup or a technology company which is not very used to the heavy regulatory burden that financial institutions have. So it's very important that this cooperation is done in a way that benefits both parties and that is not does not provide any type of limitation to innovation, and at the same time it complies with the regulation of financial services to whatever extent it is required. So I will go for the next slide in terms of the old versus the new financial services sector. So before we used to have the concept of suppliers. So one would require a core banking system, or one would require a particular software for a specific purpose, and we would ask a particular outsourcer or IT provider to give us to program according to our specifications. Now there is a new paradigm. So basically now these technology companies have become partners because they try to set up a particular solution that answers to a number of challenges in the banking industry, and also the technology is evolving so fast that there is a need for a constant dialogue between what used to be a supplier and now is a partner, and the client, the other partner. So basically there is an ongoing evolution through an ongoing dialogue that allows the partners to basically be able to interact and to share information that will benefit the creation of better and better solutions going forward. So with this in mind, with the ability to have technology solutions that are updated on a constant basis, there has been a creation of effectively an ecosystem of different technology companies. And these technology companies have emerged in all the different verticals, and they are able to basically be part in a modular way of any solution that a bank might require, whether it's a particular product or whether it's a full set of services that the bank may need. So effectively, I would say that these technology companies have emerged, and obviously they may have different approaches. Some, they really prefer the collaboration, as I was mentioning before, so the sharing of information with their partners slash clients, these financial institutions. Some others do believe they have an edge, and they believe they don't necessarily have to cooperate with these financial institutions, and they eventually go out there and try to compete. And obviously, ultimately, they will require licenses as well to compete in a regulated market. There's not anymore much solutions that do not necessarily require regulation. So although the regulator has been quite easy on the first few years when this evolution was taking place, now we see regulators stepping in and guaranteeing that these new technology-driven players are actually in the same level in terms of requirements as the incumbents. And then there is the aggregation. So basically, you have technology companies being bought by financial institutions. So there is a full merger of innovative ideas, innovative technologies with the existing businesses. So I would say the banks effectively need to search for the right sort of partners, for instance, in the same way the auto industry does today. So as you know, the automotive industry is well known for basically just being an orchestrator of or a manager of all the different parts of the supply chain. And they basically have different entities that they outsource to combine the different components of your car. The same way a bank now is trying to do something similar. However, you also require to differentiate yourself from the different players out there. So this is the challenge, to guarantee that you will not go exactly to the same partners that other banks are using, and that you do not go to a point where your product eventually or your customer experience is very similar to other institutions. So it is very relevant that you try to innovate constantly, and that the customer experience and the customer satisfaction is provided at the top level. And this is the only way I would believe financial institutions will be able to provide. We do know that under the current model of universal banking model, it's quite difficult for a bank to be great at everything. They used to have a very comprehensive and universal model, but now there is so much innovation in the different segments that and obviously competition, that effectively this will create a tension and the pressure for banks to actually start specializing. So in terms of achieving the business objectives by leveraging the right partnerships, one has to decide first what are the priorities, what parts of the value chain do you really want to control, and how do you want to make a differentiation. So there are parts of your value chain that are not that relevant. Those ones you can certainly outsource or you can eventually commoditize. I'm talking about, for instance, back office or middle office functions whereby the client is not exposed to it, but they are very, very relevant to have a seamless process with the client. So, as I said before, technology is evolving quite fast, and one should ideally be agnostic and be able to jump from one solution to the other, because obviously you don't want to be stuck with a technology that suddenly became obsolete or is not effectively the best solution nowadays. I know this is easier said than done because obviously a financial institution, like any entity, requires a return to provide return to shareholders. And obviously you cannot just invest millions in a particular technology and then tomorrow throw that away and invest in a new technology. So effectively, you should have some sort of partnership so that the technology is not necessarily developed by you from scratch, but you can actually partner with someone which has invested in that technology and they can be a service provider for you. So as you see, also there is this event of, thousands of startups coming into the tech scene, particularly in the fintech scene, and we see them bringing more innovation, whether it's people with the technology background that are interested in the financial services world, or whether it's former financial services employees that have had a particular experience and they believe they could do better or they could have a solution to provide to the financial services industry. So there are different perspectives. These startups are also becoming a bit more sophisticated, and they are basically picking up on certain technologies that have been used in other industries to bring to financial services. However, teaming up with startups has obviously associated risks. The size of the teams, the funding, whether the startup is well funded or not, and whether the startup will keep the focus on that particular technology that has pitched for you, and that in the next few years it will not move somewhere else. So it's quite relevant that you choose the right partners, and at the same time that you always have some sort of a backup plan in case the startup eventually is no longer there in the future. So the other aspect has to do with products and services. So you want the products and services to penetrate your market, and I believe partners can provide the right customization for your clients. So if you do provide the same product and a closed-end product which has no ability to evolve, then you won't be able to really be able to update constantly with new features. So I would recommend that this type of product or services that you launch together with a startup or a technology company, you actually guarantee that the product will be able to be updated on a constant basis. Then there is the integration issue. So effectively, the heart of the technology systems of a bank is the core banking system. So whatever product that you actually purchase or that you subscribe to has to guarantee that is fully integrated with your core systems. So your core systems really have to have the ability to integrate in a quite fast and easy fashion, so that eventually, if this particular partnership does not work out, you can disconnect and connect with some other product from another company. And also, if you want to integrate and you want to provide the product experience to your clients, you don't take months or years to actually come out to the market with that solution. That's point number one. Point number two is the back office automation. A number of these partnerships, banks tend to basically focus only on the front end, but it's very relevant that there is a guarantee of middle and back office automation, because otherwise the customer experience provides initial expectations, and then at the end of the day, you will have the risk of slowing down that process and having a lot of interactions, and the client gets frustrated because he was expecting some sort of quasi-automated service which doesn't really exist, which is just a front. So it's very important for this point not to be overlooked, and to guarantee that you automate to the extent possible the back office, not only to provide the right customer service, but also to minimize the operational risk. So in terms of regulation, as we all know, regulation is key to the financial institutions. So it's really important that when you bring in a new service or a new technology, that you always have regulation in mind, and that you have an open dialogue with the regulator. So it's also very important to know that, in particular, if you are in the European Union, sometimes, although we would expect to have harmonization across the different European countries, this is not the case. So even if it's the same directive applied across the different countries, there are different views and interpretations from the different local regulators or country regulators. So it's very relevant that you take that into account if you, for instance, do an European rollout of a particular technology. So it also is very relevant that digitalization becomes possible. A long path has been covered in the last few years, and we believe regulators have catch up quite a bit in terms of allowing the right legal framework to have the possibility to digitalize to the extent possible. So digitalization in a number of countries is already a reality. However, there are still some cases where it is not yet possible to have a full digital process. So one has to be careful if regulators still have some roadblocks that will not allow you to have the full digitalization of your processes. Then the other aspect is the data protection law. In Europe, again, it has become some sort of hurdle whereby, with all the requirements that are needed, that has become that has provided an additional complexity, particularly in what concerns onboarding new clients and simplifying this onboarding process. On the other hand, it has become a bit more cumbersome because of all the requirements associated with the data protection law. So I would say, ideally, it would be important to revisit this and guarantee that in Europe, we are basically at par with the rest of the world, particularly the Asian region, and China in particular, where it's much easier to do the onboarding. So some issues that are typical and that regulators have different views from country to country are, for instance, the KYC process, the digital signature validity, interest rate caps for consumers on loan products, which is common that certain countries have higher interest rate caps, some have lower, and some don't even have interest rate caps. Then credit information, some have available at their disposal positive and negative credit information. In some other countries, positive information is not possible. Some have integrated with other industries like utilities. Some countries have not integrated due to data protection issues. So we see there's a myriad of issues that sometimes make these credit algorithms not to be optimal when it concerns to credit approval. Then the account opening and account transfer. So if you are trying to do a remote account opening, there are different challenges from one country to the other. And then the whole blockchain technology, whereby, for instance, we are able to use smart contracts to basically almost automate the decision process based on certain premises. So we see that in certain countries, they are trying to create a legal framework for smart contracts. However, others have not yet done so. And I believe this is a constraint, obviously, to the deployment of more efficient solutions through the technology of blockchain. So, in order to avoid this regulatory arbitrage across the European Union and in order to have a more globalized world, I think we should try to have regulators converge and try to harmonize to the extent possible all these types of regulations. Otherwise, the different countries risk losing out in terms of competitiveness, some versus the others, obviously. So I would provide now just two examples of what we mean by cooperation. So the first example I set in this slide represents a typical solution where you partner with different technology partners to have a fully digital online consumer lending solution. So if you create a fully digital online consumer lending solution, means that ultimately the client has the ability to request a credit and have no human interaction whatsoever until the credit is disbursed. We do know that some clients may require some attention and may require some support during the process, and obviously these tools may require you to intervene in case the client doesn't complete this journey. But there are a number of technologies out there that today allow you to have the client to be onboarded, to be analyzed from a credit perspective, to be identified as a client and do the KYC, and to actually make a proposal according to his expectations. And then ultimately, if he's in agreement, to have a digital contract whereby he agrees with the terms and conditions, he signs digitally, and ultimately will be able to disburse. So this is an experience that is clearly possible nowadays, but it would be difficult for you to do it from scratch and to continue developing this in-house because it would take you time and it would not guarantee that you would get the best technology, or that these technologies that you would be basically betting on would not be obsolete a few months or years from now. So effectively, it's relevant that you do this or develop this type of platform in a modular way so that the product is able to be continuously evolving, so that you would replace certain modules to eventually update a particular section of the customer journey. And you would be able to launch new products associated with the consumer lending space. So this will provide also a guarantee that you are a nimble player where you would launch new products or you would explore new channels. On the base, you have the different technologies, and then you can just adjust. You can adjust according to the new product that you launch or the new origination channel that you are trying to focus on. The second example is more of a, I would say, a business partnership rather than a technology partnership. So in this case, you want to launch a service that you do not yet provide. However, you are not necessarily interested in developing everything in-house and creating the whole infrastructure. So you can actually team up with a fintech that is expert already, that has expertise on a particular business area. So in this case, invoice discounting. Let's say you do not have this as part of your product portfolio, but you may have some clients that are interested in this product and you want to test the market and you want to provide additional products to your clients. So you can eventually be able to partner with such fintech, which allow you to basically get a share of the revenue. Obviously, you will not get the full revenue because there is work to be done by the fintech and they have to be paid. So you ultimately become an origination channel and they do the analysis of the client and they can approve the client according to specific credit risk criteria. Then you take a decision whether you want to keep, in this case, the credit exposure or if you want to pass it on to a third party. So effectively, there are three components to this particular case. There is the origination side, there is the analysis side and servicing side, and then there is the credit exposure and the return associated with that exposure. So effectively, one could have different partners in each of these segments. In our case, we decided to basically be a partner on the origination side as well as on the credit risk exposure side because we wanted assets for our balance sheet. So this left the fintech with the ability to actually process the clients and be able to provide a solution where it will select the right clients and it will monitor the performance of these clients. So needless to say that if we wanted to do all this, it would take at least 24 months to set up the whole infrastructure, where in this case, we would be up and running in 2 months. So the key takeaways are basically the following. So the technology disruption is actually going to continue, and we believe it's going to accelerate, and we're going to see new business models coming out every year. So one has to really quickly adapt to this new paradigm and overcome, in particular, the legacy issues, because we know that the financial services industry is based on older systems and they need to be renovated. Then the new technology of today, we are sure it will become eventually obsolete, but the acceleration of obsolescence, of becoming obsolete is getting faster. So that's why we have to be flexible and to be able to adopt that technology that is right at that particular moment. Then the business models and processes have to be reviewed frequently. So effectively, one has to be conscious that very disruptive technologies allow you to redesign the whole process and the whole business model as well. So there could be new business models, there could be redesign of processes with these technologies. So it's important that you review them frequently. And then finally, regulators should keep an open dialogue to guarantee that the financial services actually evolve. I think a big issue is that regulators have not been used to speak directly with the technology companies. And I think some of them are doing that, and those are really the ones who are able to progress faster. Because the same way banks need to understand what these technologies are for and what their use are, what their risk or benefits are, regulators also need to be exposed to these technologies by having an open dialogue and having an area which focus on analyzing these technologies, analyzing the use of these processes in the financial industry, and then approve the technologies as good to actually be onboarded by the banks. Obviously, banks have been trying to bridge that gap by presenting the cases to the regulators, but I think regulators should even anticipate that and try to be prepared before banks come with potential solutions, and also they should be aware of this ecosystem and the solutions that are out there. So with that, my conclusion is that in the next few years, and also because of the current situation, we see even a higher acceleration of adoption of these technologies as we become more and more familiar of working remotely and allowing transactions to be done seamlessly through digital means and through an automated way. So I think the future is really bright, and more technologies will be coming, and the ecosystem of these fintech companies or technology companies will become bigger and bigger and more globalized. So thank you very much for your attention, and I hope this was interesting, and I will stop sharing now. And Nora, it's your turn. Thank you.
Thank you very much, Pedro. It was really fascinating to see how banks and fintechs should find a common platform to work together, to cooperate. And my question is that as a seasoned banker, what has been your biggest challenge when working together with fintechs?
I would say there are different challenges, not one single one, but I would say the biggest challenge has to do with their ability to understand that the financial services industry is a heavily regulated industry. And sometimes fintechs don't really think too much about this. They are free. They want to develop ideas, but we have to go back to them and say, we have to take different steps in order to approve your technology or to approve your process. So it's quite a long process. And obviously, these startups are usually impatient. So they want to develop very fast. But obviously, financial services is a very regulated industry, and we need to really make sure we reach some sort of agreement to allow us to develop in a careful fashion.
I fully agree with you. Sometimes I feel this relationship between legacy banks and fintechs are a little bit like the relationship between adults and adolescents, teenagers. No, they want to rush, they want to go ahead, they are full of fantastic ideas. They don't want to respect the rules necessarily, they want to challenge the rules, and we adults will try to stick to the rules because we know, we have experienced why they have been installed in the first place.